I'm Jen Shaw, leader of Dean Dorton's equine practice. I'm joined today by my colleagues Sherry Hellman, who runs our firm's equine outsourced accounting group, and Melissa Hicks, who runs our firm's equine tax group. Many of you have attended our seminars in the past, and this year we're shaking things up a bit. Instead of having a one-day in-person seminar this fall, we'll be releasing a series of webinars aimed to address timely equine industry topics. Stay tuned as we release the registrations for those seminars. Melissa, you authored a great article in the August issue of Blood Horse that talked about preparing for the sales from a financial and tax perspective. There are many good points in that article, but there's been a lot of horses purchased over the past few months, and so I thought it'd be good to get together today, the three of us, to talk about what it means from an accounting and tax perspective when someone buys a horse. Now, I realize that that's probably not top of mind and not necessarily should be for those that are buying horses, but for us accountants and for accountants across the country and family offices who have to account for these things, I feel like this information is gold. So Sherry, let's start with you. When I buy my dream horse, how do I treat it for accounting purposes?
Well, Jen, when you buy a horse, it is capitalized on the balance sheet along with all of the expenses related to the sales. So sales commissions, vanning costs, all of that are included in the capitalization costs. And then it's depreciated over time. Now, if you have a pinhook that you are looking to buy, or if you have some personal horses, those are also classified as assets on the balance sheet, but those are not eligible for depreciation. So all in all, for your horse businesses, if you're ready to buy a horse, it will be capitalized along with all the expenses. So for horses that you purchase for your trade or business, these can be depreciated over time once you place them in service.
Now, Melissa, can you talk a little bit about what placed in service means?
Sure. Well, it means different things for different types of horses. For a sport horse, when a sport horse goes into training or starts competition, it's considered placed in service. For racing prospects or race horses, they can be placed in service in the fall of their yearling year or when they first race. For breeding horses, they can be placed in service when they're available to be bred or are breeding.
And Melissa, it's good to remember too that once you choose a placed in service policy, that you be consistent with that for future years as well.
That's right.
That makes sense.
Thank you.
So Sherry, what does it mean to depreciate versus expense?
Well, basically, it just means that you are taking the purchase price of the horse and depreciating that expense over a period of time. For race horses, it's approximately 3 years. For brood mares, it's approximately 7 years, depending.
So Melissa, how does depreciation work for U.S. tax purposes?
Well, similar to what Sherry just said, we can deduct the purchase price and the related acquisition costs over a period of time. We still have bonus depreciation, which is a great thing. So for qualifying purchases, you can take up to 61 to 84% in this first year.
In 2024?
In 2024, depending on the type of horses purchased and which depreciation method is used.
Well, that seems like a lot of the purchase price still. So can you talk a little bit more about what qualifies for this bonus depreciation in 2024?
Yeah, most horses qualify. There are a few limitations if you previously own the horse, or if you buy it from a related party, that does not qualify for bonus depreciation. So you got to watch for those things. But then also assets that you use in your horse business, like farm equipment, office equipment, barns, land improvements, those things all qualify as well.
So Melissa, are there any limitations to the bonus depreciation that you just mentioned?
Not really. Bonus depreciation actually lets you create tax loss or increase your tax loss. That's different than Section 179. And also, if you buy an asset, as long as it's placed in service, even if it's on the last day of the year, you can claim bonus depreciation.
So Melissa, for U.S. tax purposes, what is regular depreciation?
Well, U.S. tax purposes has a depreciation system called MAKERS, and it allows you, for most horses, are depreciated over a 7-year life. There are some horses that are depreciated over a 3-year life, and that includes race horses that are over 2 years old and brood mares that are over 12 years. But then MAKERS, it's not straight line depreciation. You can actually go to an IRS publication 946 and find out what your rate is. So that's really what depreciation is in the U.S. Now, unfortunately, if you have a horse that is not used in the United States, a foreign use horse, it's depreciated over straight line 10 years or 12 years.
thing to point out is that most states don't comply with bonus depreciation, so oftentimes there's federal state differences and multiple books that we have to track for these horses, especially each state is not necessarily the same, and so that's certainly something to think about too as we're looking at depreciation from a tax perspective. Sherry, any other tips from an accounting perspective?
Well, generally, Jen, we recommend that activity is tracked per horse so that you have a financial record of that horse's performance. Most of our owners know which horses are most successful. However, when we find it helpful, when we can back that up with true data or true financial information. We have specific accounting software that we utilize to track this over the life of each horse. We even track multiple generations or progeny of the horses, particularly for our breeding clients.
All right, Melissa, you talked a little bit about U.S. tax depreciation. Are there other limitations from a tax perspective that horse owners should be aware of?
Yeah, you're right. There are a lot of great tax incentives for the horse industry, but there are also some limitations you have to keep in mind. One of those is whether or not you can utilize cash basis or accrual basis accounting. Another is excess business loss. An excess business loss limitation may limit your loss in the current year, but then you may get to take that in the next year. Then you have to get into passive activity rules. The passive activity rules come into play based on the involvement that you have in the industry. And then finally, all horse owners need to be aware of the hobby loss rules. The hobby loss rules really are tough because you have to include gross income, but you don't get to take any of the deductions.
I agree. That's a tough designation, and quite frankly, I spend the bulk of my time these days working on IRS controversy work with horse and farm owners across the country. So it is a hot button topic. So I do think that having horse and farm owners aware of these limitations and then running their horse operations as they're supposed to be, and as I think that they are running them, is helpful from a tax perspective as well. So, well, I really appreciate you all taking the time to sit down and talk through some of the accounting and tax basics. I hope it's been helpful for our audience. Stay tuned as we release those registrations. Again, please feel free to reach out to us or to your advisors. This has been a general discussion, and so we don't want you to take any actions based on our general discussion today. Check out our website for more information on equine accounting, tax, and consulting, our sales and use tax guide, and our upcoming webinars.